Hi everyone, first of all, thank you for having me. My name is Jivan Surajgade and I'm going to be speaking you today about money market. So let's understand what is money market and what are the instruments of money market. Okay, so let's begin. So money market is a market where short-term securities are traded like certificate of deposits, commercial paper, etc. In this case, maturities are less than a year. Money market securities are used for short-term lending and borrowing. Maximum life of money market is 1 year. Money market securities are unsecured except repurchase agreement. Okay, so it is actually a highly liquid market and it's not a place but a system. So let's understand the instruments one by one. So the first one is that certificate of deposits. Certificate deposit is a negotiable financial instrument which is issued by bank for borrowing money for short term. Certificate deposits are issued in fixed denominations. Certificate deposits are issued at par and pay interest on principal value. Certificate deposits are can be traded on OTC market, that is they are negotiable instruments. Certificate deposits are unsecured. In this method actually interest is calculated by using simple interest formula, that is interest is equal to P into R into N. Second instrument is that commercial papers. Commercial paper is a negotiable financial instrument which is issued by corporates for borrowing money for short term. Commercial paper are issued in fixed denominations. Commercial paper are issued at discount and redeemed at par. The difference between issue price and redemption value is deemed interest. Commercial papers are issued through private placements. The most important thing is that commercial paper can be unsecured, can be traded on OTC market, that is they are negotiable instruments, and commercial paper are unsecured. Let's move to the third point, that is treasury bills. Treasury means government. So treasury bills is a negotiable financial instrument which is issued by governments for borrowing money for short term. Treasury bills are issued in fixed denominations. They are not interest bearing. Treasury bills are issued at discount and redeemed at par. The difference between issue price and redemption value is deemed interest. Treasury bills actually issued through auction process. It is called as a Dutch auction. Treasury bills are can be traded on OTC market, that is they are negotiable instrument. And one more thing, that treasury bills are unsecured but the issuer is government, so they consider safer. In auction process there are two types of bidder participants. The first one is competitive bidders and second one is non-competitive bidders. So competitive bidders are the bidders who bid for the yield, who bid for the return, and non-competitive bidders are the bidders who actually take average of all competitive bidders, who allocated T-bills at the average rate of all competitive bidders. Okay, so in non-competitive bidders, T-bills allots at the ascending order, means lowest bid first. Okay, next the next point is that repurchase agreement. Repurchase agreement is a agreement or arrangement between two banks to borrow and lend money for short term. Repurchase agreements are not traded as their arrangement as their arrangement to borrow and lend. Repurchase agreement are only money market product which are secured. Okay, in repurchase agreement, security given as collateral is later repurchased at higher rate. That rate is decided between two banks. And last point is that interbank lending. Interbank lending is actually it is a lending and borrowing for short term. The rate is decided between two banks. It is unsecured and it is the interbank lending are not traded as their arrangement to borrow and lend money. There are four types of interbank lending. The first one is that call money. In call money, money is repaid back only when the lenders call for it. Second one is that notice money. In notice money, money is repaid back after fixed notice of period, that is 2 to 14 days. And third one is that term money. In term money, money is repaid back after fixed notice of period, that is generally more than 14 days. And last one is that overnight money. In overnight money, money is repaid back the next day. So this is all about this is all about money markets. Okay, so thank you so much for listening and thank you so much for your attention. Thank you.